Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Hydro One stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or sell. Hydro One is an electricity transmission and distribution utility company throughout the province of Ontario. The company IPO'd on the Toronto Stock Exchange in 2015. It is a holding company with 4 subsidiaries, the largest being Hydro One Networks. It operates 98% of the high voltage transmission grid throughout Ontario and serves 1.4 million customers. Let's get started with the model. We're going to look at the ticker that trades on the Toronto Stock Exchange. The ticker is H.TO. The company also trades on the pink sheets in the United States. The ticker is HRNNF. This is a large cap company. They're trading at $28.55 a share, and they have 598 million shares outstanding. Let's look at the financials. All the numbers are in Canadian dollars. The way you value a company is you forecast their future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company had positive free cash flow in 3 of the 4 years. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they also had positive net income in 3 of the 4 years. Their revenue looks really good. It's growing every single year. And they had really strong profit margins in 2020. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. And they converted 25% of their revenue into profit. That means 75% went towards expenses. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. And then the difference between those two numbers is the gross profit. So you can see the company has growing gross profit each year. The operating expenses are pretty consistent, $800 million to $850 million a year. And their operating income was the highest in the trailing 12 months, $1.5 billion. This company has a good amount of debt, so they paid nearly $500 million in interest payments on their debt. They have a small amount of other income and expenses, and then taxes. So the bottom line of the income statement is their net income, and that was $1.8 billion in trailing 12 months, much higher than prior years. A big reason for the large net income in the trailing 12 months was this negative $810 million in taxes. Companies in the utility industry provide an important product. Companies like this receive subsidies, and it's a lot easier for them to defer taxes. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. And then you have capital expenditures. These are investments in property, plant, and equipment. And you can see a company like this has lots of CapEx. To calculate free cash flow, it's operating cash flow minus CapEx. And they had the best year in the trailing 12 months, $331 million. In 2019, they did have negative free cash flow because their CapEx was higher than their operating cash flow. Capital expenditures aren't always the most predictable. And the company doesn't issue much capital stock, only $6 million in 2019 and $8 million in 2020. But they do issue a lot of debt, $4 billion in 2017, but they also paid $4 billion that year. $5.6 billion in 2018, and they paid $4.7 billion. In 2019, they issued pretty much the same amount as they repaid. Same thing with 2020. Because when debt is due, companies usually don't pay down the debt. They just issue new debt to pay the old debt. It's called rolling the debt. And when you invest in a company, you want to make sure they have positive operating cash flow, because you can't have a viable business if it always has negative operating cash flow. And this company does have positive and healthy operating cash flow each year. The way you calculate operating cash flow, it's net income, and then you have to add back the non-cash items from the income statement. So we have to add back $774 million depreciation. Remember, on the income statement, they added $841 million of taxes. So we have to reverse that out on a statement of cash flows because that's a non-cash item. And working capital increased their cash flow $203 million. So when a company buys on accounts payable, that's an increase in cash flow. Also, when a company receives payments from past due invoices, that also increases operating cash flow. The financials look okay. The only concern is the amount of debt they have. Let's look at a capital structure. $9.8 billion of equity and $12.7 billion of debt. And they have the same amount of net debt, so they don't have much cash on their balance sheet. They pay about 3.5% interest on their debt, and cost of debt is about 3%. And 56% of that capital structure is debt, which means 44% is equity. Cost of equity is 3.9%. And they have a really low beta, 0.21. The lower the beta, the less volatile the stock is. So investing in a stock with a low beta can help, especially during volatile markets like this. And their WACC is 3.5%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years their future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $13 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $12 billion. We divide that by 598 million shares. And we get a calculated stock price of $20. They're trading at $29, so they're trading at a 42% premium. It's a sell according to the model. Simply Wall Street is a little higher than me. They're at $25, so they're also saying the stock is overvalued. So you can see the stock was pretty steady for about 3-4 years, then jumped a lot in the beginning of 2020, then dipped in March like everything else. But it looks like the stock is almost at its all-time high. The company has been increasing their dividends from 2016 onwards. It was 21 cents, and they increased it up to 25 cents. It looks like they were paying 34 cents, but they cut it drastically in 2016. And utility companies tend to pay good dividends because they receive consistent revenue streams. And their dividend yield is 3.5%. Their payout ratio is 33%. Payout ratio is annual dividend payment over net income. The stock has pretty much been mimicking the S&P 500 the past 52 weeks, up 15%. And the 52-week low is $20, the high is $30. And the stock is trading above its 200-day moving average, but below its 50-day moving average. So it is in a slight uptrend. And when the 50-day moving average moves above the 200-day moving average, that's called the golden cross. That's a bullish signal. And the trading volume for this stock is about 1 million shares a day. And of the 600 million shares outstanding, about half are on float. The province of Ontario holds 47% of the company's stock. So only half the shares are available to people like me and you. And institutions hold about 22% of the shares outstanding. And the company has a pretty low short percentage. Only 2.2% of the shares are shorted. Let's look at the financial ratios. The average PE in the market's 12.2. The median is 14.8. PE is stock price over earnings per share. They're at 9.4. So that means investors are paying $9.40 for $1 of earnings. That's a really good PE ratio. Price to sales is stock price over sales per share. They're at 2.5. Also another good ratio. Price to book is stock price over book value per share. They're at 1.7. Really good ratio as well. And to calculate book value per share, that's equity over shares outstanding. And their equity is $9.8 billion. Equity is assets minus liabilities on the balance sheet. And their tangible equity is $8.6 billion. So they have a little more than $1 billion of intangible assets on their balance sheet. An example of an intangible asset is goodwill. Interest coverage ratio is EBIT over interest expense. They're at 3.4, so they can cover their interest payments. ROE is net income over equity. They're at 18%, so they have a really good ROE. Current ratio is current assets over current liabilities. They're only at 0.4, so they can cover only 40% of their current liabilities. Almost all their current assets are tied up into receivables, $1.1 billion. This is money owed from other people. So they've extended $1.1 billion of credit to its customers. The company is not well capitalized. Their free cash flow in the trailing 12 months was $331 million, but they have negative $1.8 billion of working capital, so they're going to need a lot more debt to get through the next 12 months. The best way to look at ratios to compare them to similar companies, I've done videos on Evergy, Alliant, and Next Era, all in the same industry as Hydro One. And if Hydro has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're better in all the price multiples, price to earnings, price to sales, and price to book. They have a bad current ratio. ROE, they're doing really well. They have the most debt of all the companies. And their market cap is similar to Alliant and Evergy. Next Era is a monster. And they do pay a higher than average dividend, 3.5%. Average is 3.18%. So to summarize, I do have them trading at a 42% premium because it seems like their stock price is too high. But this company is not going anywhere. They provide a product that's really needed. So this is definitely a good, safe, long-term investment. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.